Give us, first of all, a sense of your perspective of the kind of trading activity we've seen this week, where the market was largely coming under pressure as a result of profit taking and then seeing that ticking higher just yesterday.
Well, it's expected at this time of the year, first quarter, where the festivities are over, people are focusing on the year's plans, and most investors are looking at any opportunity, profit-taking opportunity on the various counters that they've been holding over the past 1 year.
Well, we've been saying that the pullbacks that we've been seeing on this market will remain shallow ahead of the slew of full-year results that are being anticipated. One company that was out with numbers yesterday, CMC Holdings, showing a 2010 pre-tax profit down 28%. We had earnings per share dropping to 70 cents as well from 93 cents a year ago. Overall impressions of the numbers there?
Well, the share traded, the stock traded sideways. The top line marginally increased, but you find that the EPS decline was mainly attributable to higher operating costs and higher finance costs. So I think CMC need to implement strategies of cost control, and also how they are going to manage their finance costs in order to be able to have a better performance, say, in the next half or the next full year. But the market reacted was such that it was more or less level.
Despite that being the scenario that CMC Holdings finds itself in at this stage, we had the company announcing that it will be paying a final dividend of 20 cents per share. A prudent move in your books when they've still got so much to get right?
Well, it reaches a point where you also have to appease the shareholders a bit. And 20 cents per share in regards to their performance, I think that's not so bad for its shareholders.
Globally, though, we've had car manufacturers seeming to start boasting nice turnarounds, so there seems to be brighter days ahead. Quite a few hurdles that this company still needs to clear, as you've outlined, and more in terms of their cost efficiencies moving forward. Would you be a buyer in CMC Holdings right now?
Well, until they come out clear in terms of what they want to achieve. You see, CMC is really suffering in this market in terms of second-hand importation of vehicles from Japan. So if then probably they can restructure their pricing in order to appeal to the Kenyan market and more so the middle income level, then probably that's when it will show some certain signs of improvement in their bottom line.
Let's take a look at some of the other players that have been stealing attention. Mumias Sugar posted a roughly 50% one-year return. It's sitting on just under a 10 PE multiple, but many saying it's to date seriously underperformed that raw sugar price action since September last year. What's the primary reason, in your opinion, for the divergence in the trend we're seeing between the company's share price and that real sugar price in the global markets?
Well, first and foremost, Mumias Sugar has a very large free float. So, say any incremental movement in price, profit taking comes in, and you find that it gets depressed again. But at the same time, there are investors who got in at very low levels, at levels of 3 shillings. So they've been smiling all the way to the bank in terms of returns. In addition to that, there's the COMESA safeguards which will be open come 2012. So there's a lot of hesitation from investors in terms of how that will impact on Mumias Sugar going forward.
In the meantime, we have the banks moving in tandem with GDP growth and growth prospects in the country. Equity Bank is just off its all-time closing high from 2008. We've got KCB taking a serious look at 24 shillings, and that's a hurdle that it's not been able to cross for the past 2 years. Barclays is up just under 20% since December as well. Just how much more upside do you see for these banking counters in the current Kenyan scenario, even with that growth story that's sounding pretty strong at this stage?
Well, regionally and also continentally, Kenyan banks have been trading at very attractive multiples, most of them being very discounted. I mean, with say KCB trading at P's of 10. Now, there's still some upside potential. There's still room for growth, and there's forecast by investors because we are expecting full year results coming out from February to March. So probably some 10-20% increment can still be achieved.
Let's take a look at KCB, just because you've mentioned it there. It's posted a 29.8% one-year return so far. It trades on a PE of 8.4, which is a steep discount to its peers, and it's announced as well a very aggressive regional mortgage rollout plan, and the more aggressive growth strategy is set to be factored into the share price moving forward. Will you be nibbling at KCB right now, looking at current valuations?
Well, definitely, KCB is a strong buy. I mean, just looking at their performance in terms of capital raising, they're more or less successful in their rights issue. They've been posting good profits. Their operations in the region have also been contributing quite well to their bottom line. Now, they're also focusing on Southern Sudan, for which the results for the referendum should be coming out soon. And they want to boost their presence there in terms of taking advantage of reconstruction, infrastructure development. So KCB is definitely a buy.
Has there been any commentary out in the market, Steve, regarding the kind of credit lines we're seeing being extended by these Kenyan banks and the level of non-performing loans that are still out there at this stage? Has there been any news on those fronts?
Well, not at the moment, and you find that banks are normally very closely guarded in terms of their non-performing loans, and also you see provisions, loan loss provisioning is normally at the discretion of the bank, so not really an objective position that they give in terms of how they come up with it.
Well, we'll be waiting for their full year numbers to really analyze some of that detail moving forward. Banks aside, we've been hearing quite a few of our market watchers say that marketing should perform well moving into 2011, taking the spotlight away from the telecoms firms. Scangroup seems to be the favorite in that space. A stock that's piquing your interest?
Yes, definitely. 2010 and also 2011 is expected to be a better year. I mean, we are seeing growth prospects from GDP levels of 2.6%. Expectations are at between 5 and 6%. And you find like that Scangroup counters that once then there's an uptake or a bullish trend in the economy, then definitely the stock will reap gains from that as advertising expenditure increases. But at the same time, Scangroup has been very strategic in its marketing and also positioning in the Pan-African region.
Well, of course, as I mentioned, taking some of the spotlight away from telecoms player Safaricom, we heard just yesterday that Bharti Airtel's unit has added 2 million new users to its network since slashing tariffs in August last year, and that effectively doubling its active customer base to 4 million. Impact on Safaricom as you see it, because we saw that share price moving higher despite that news coming to the fore.
Well, Safaricom still remains the largest market share in that sector. I think Airtel is mainly focusing on volumes in order to be able to probably increase the numbers, subscriber numbers by probably another 1-2 million. But I'm sure Safaricom will come up with a reactive strategy to that.